Hello, this will be the lecture for Monday, September the 14th, I believe. And we'll be going over less than 100% ownership of the subsidiary company. But before I get to that, I want to correct something that I did on exercise 5 on Friday. So on exercise 5, this is the one where we had a gain. Okay, remember we had this gain of $185,000, and originally when I did the eliminated entry, I eliminated it by crediting the gain. Okay, well, when you did an original journal entry on their individual income statement, they would show a gain. Okay, but you can't have a gain in yourself. So when you're doing the elimination entry, you need to credit retained earnings because ultimately it increases the parent's retained earnings. So that's where the gain is recorded. So make sure you note that change to exercise 5 when you're looking over your notes. Okay? Sorry about that. I wasn't thinking. All right, so back to, oh gosh, I can't see to get back there. Okay, back to our notes. That's not in. Okay, so we're doing an example where they invested in 80% of the stock. And I'm actually going to work through the numbers in the book and then do an exercise. But I might do the exercise separately and post it separately. Might get a little bit long for a lecture. All right, so let's see. We're looking at Sample Company and Parental Incorporated. So Parental purchased 80% of the outstanding stock of Sample. All right, and then here is Sample's balance sheet. Okay, and they give us the book value and the market value, and all that's already done. Okay, assume that Parental Incorporated issued 16,000 shares of its dollar par value common stock for 80%, or 8,000 shares of the outstanding shares of Sample Company. The fair value of a share of Parental stock is $25. Parental also pays $25,000 in accounting and legal fees to accomplish the purchase. Okay, so for the original investment in Parental, it's going to be just like you did all along, all right? They're investing in Sample Company, so I've got the 16,000 shares at the $25 fair value. So they're going to have an investment in Sample for $400,000. In this case, they issued their own stock out to Sample. So they're going to have the 16,000 shares of common stock credited at par, at a dollar par, and then the difference is going to go into paid in excess. Okay? And then we have the acquisition expense being recorded as well. All right, now I'm going to start off with this with the value analysis. You know, this is the balance sheet that we did kind of at the top, and we used it to get net assets. All right, they've already calculated the net assets, the fair value of the net assets for us right here. So it's the 505 minus the 140 equals the 365. And I guess I don't need all this blank space. So let me go ahead and move this back up. Okay, so when we do the value analysis, and this is, we have less than 100% ownership. So you start off with the original investment here was $400,000. All right, that's what they invested. All right, so that's where they got the $400,000. Now, the NCI still has a part of that. Sorry, I got sidetracked there for a minute. Okay, so this $400,000 right here, this is 80% of the company's implied fair value. All right, so we want to figure out first what the full implied fair value is. Like if they had bought the whole entire 100% of the outstanding stock, how much would they have to have paid for it? Well, what you do is you come over here to the company implied fair value, and you take what the company paid for 80% of it, and you divide that by the 0.8 or the 80%. All right. So if they paid 80%, if they paid 400,000 for 80% of the company, then that implies that the company as a whole is worth 500,000. Okay. And then you can either subtract, or you could do the 500,000 times 20%, because that's the NCI's value, to get what the NCI is. Okay. Generally, that sometimes will change. There are some rules and exceptions there, but that's how we're doing it today. Okay. All right. Then remember that the fair value of the assets was 365. Okay. So the fair value of the net assets was 365. All right. The parent gets 80% of that. And then you can either subtract, or you can do times 20%. Either way, it should come out to be the same thing. Right. And then you do the fair value minus the fair value of the net assets, the company fair value minus the fair value of the net assets, and you get the goodwill. And you can just carry that on across. And we did not have a gain, so they just like to put in a. Okay. And I explain all that down to you down here. All right, now the other thing we need to do. The next thing we need to do is the determination and distribution of excess. So you know what? I'm going to pause this for a minute and go ahead and type this in and get it set up. There's no reason you need to watch. Okay, so next thing we need to do is the determination and distribution of excess schedule. All right, so we already had these numbers up here, the 5, the 4, and the 1. So you could just, copy them down and type them, whatever you want to do. I should have gone ahead and made these. I'll do it in a minute. Okay, and the next thing we need to do is take out the book value of the subsidiary. It goes in this first column, and this is going to be the common stock of sample, okay, of the subsidiary company. So it's these numbers right here. So we're going to have the 10, the 90, and the 60. And it's the entire thing. It doesn't matter that we just bought 80%. You're going to write the entire amount here. All right, add those up. All right, and then generally what they do in the book is they copy this. Well, you can't copy it. You just have to type it because I have a formula there. Okay, so that's the entire amount. The parent owns 80%, and the NCI owns 20%. All right, I like to do this 100% here. The book doesn't usually do that, but I like to do it because I like to put the formula in right here. And I like to copy this across. Okay, and then to get the excess is the fair value minus the book value. So fair value minus the book value. And then now that I have it there, I can copy it on across, and it's the fair value minus the book value. Okay, so it ends up tying to this over here. All right, let me make it look pretty. Then, just as before, this excess, we have to do adjustment of the accounts, and we have to take that excess, we have to distribute that excess in between, to the different accounts. All right, so back up here, they had told us what? Here's all of our fair values. Okay, so accounts receivable is the same. Inventory's got to go up by 5. Land is going to go up by 30. Buildings is going up by 50. Well, actually, it's going to go up by more. It was 150. Actually, I think I can just do the 50. Let's go see what they did. I can just do the 50. Oh, no, I have to do the 100. Okay, here's what I'm looking at. Buildings was 200 with 50 of accumulated, so their net value was 150, and now their value is 250. So for the buildings, I have to do a full 100,000. Okay, and what that was is their net value was 150, which was 200 minus 50 of accumulated. And it needs to be 250, so I have to add 100 to that. And then equipment, I have to do the same thing. 60 minus 20 is 40, and it should be 60, so equipment's going to be 20. Alright, and then I need to put in a copyright. And you have anything over here? No, the liabilities stayed the same, so that's good. All right, now we know from earlier, we're trying to get to this number right here. All right, we're trying to get to this 340. Let me come down here. All right, this total should equal the 340. I'm going to put a formula in right now. I forget that I'm not on a template and it's not automatically doing it for me. Right now it has 205. All right, so the other thing that I need to adjust is we have this goodwill up here of 135. So I need to put that 135 in there, and hopefully when I do, it equals out. So this is goodwill. That's sometimes the bad thing about a template is it does some of the work for you and you don't always realize what it's doing. So you need to pay attention to what it's doing. Okay, so there is that, and that all balances out. Now I need to do the elimination entries. Sorry, I'm getting carried away with, I can't look pretty. Try to kind of catch up with your brain. Okay. Now, for the elimination entries, they're going to be very similar to what we did in exercise 4. However, they are going to be slightly different. All right, so remember, the first thing that you need to eliminate, all right, the first elimination entry let's come over here where we kind of follow along what they're doing. Okay. So the first elimination entry is D. It's EL. All right, now on this first elimination entry, we're going to eliminate our share of Sample's common stock. All right, so we're going to debit the equity section of Sample. We're going to debit common stock, paid in excess, and retained earnings. But we're only going to do our 80%. So Samples common stock had 10,000 in it. We're going to eliminate 80% of it. Okay. Their paid in excess had 90,000. So we're going to eliminate 80% of that. And then their retained earnings was 60,000. And we'll eliminate 80% of that. All right, and then all that goes against our investment. Okay, so that's the first way. The second elimination entry is D, and it's going to adjust the accounts. And this is D for distribution. I'm not sure why they call it that. So remember, we need to increase the values of these assets and add goodwill on. So basically, you can just copy this. Because you're going to debit all that stuff. And remember that all this is being done at the full 100% as if I bought the whole thing. Okay? So all these adjustments, all this stuff is recorded at the full 100% regardless of my ownership. I take care of the ownership right here with the stock. Okay, and the rest of it you're going to see here in just a second what we're going to do. Okay, so then I know that I have to credit the investment. Okay, now what I'm about to do is wrong, so don't copy it. So if I just added this up like I did before, okay, before when we owned 100%, if you notice these two together equal $468,000. The most that should be coming out of the investment is the $400,000 that I originally put in. All right, I only invested $400,000. So this amount right here, these two added up, they should equal the $400,000 investment. Okay, this should equal $400,000 investment. I can't take any more of that investment account than what's already in there. Okay, so it should equal 400. I know I already have 128 in there. So that one needs to be for what, 232? 272. 272. Okay, so this should be 272. And if I double check it, I've got the 128 plus the 272, and there's my 400. Let me call that green. But my entry right here is not I'm having issues. I'm really sorry. My entry is not going, guys, it shouldn't balance out. There. My entry does not balance out at this point. All right, so to make it balance out, I need another 68,000 right here. All right, and that 68,000 is the rest of, it's the other 20%. If you notice up here, this is 68,000. All right, so look, here, let me highlight both these numbers. I'll keep that one the green. Now let's give this one a different number. All right, so that 68,000, that's the excess of fair value over book value, that belongs to the NCI. So that's what this number is. All right, and the book calls that retained earnings of sample. It credits retained earnings of sample. I think I usually end up crediting something called NCI, right? Because that's what it is. But basically, you're going to take the other 20% out of these accounts and put it into retained earnings of sample. But it's the NCI share. Okay, I think that's it for the lecture part. I'm going to work an exercise, but I'm going to put that on a separate recording. I lied, I'm not quite done because I want to show you their balance sheet. So after they do all these entries, the consolidated, notice the consolidated balance sheet, down here in the stockholder equity section, the common stock paid in capital or retained earnings, that all belongs to the parent. That's the parent's equity section, all right? And then notice I've got this non-controlling interest, and that's what belongs to the non-controlling interest, okay? It's broken out separately. I'm looking at the days. It bothers me that it's $100,000, but I think it has to do with days. But anyway, that's where the NCI goes. I remembered why it's $100,000. It's this implied fair value of the NCI. Okay, that's what that is. So it's their share of the retained earnings plus their share of some of the adjustments to the assets. Okay, go look for an exercise that I'm going to work out. I am going to work out, let me find it, exercise 6. So go look for exercise 6 in another video.